Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, and welcome to another episode of the Commonwealth Home Ownership Real Estate Podcast. This is the first episode of our ongoing monthly mortgage education series with Kim Nguyen. Kim is a mortgage associate with the Vine Group with over 9 years of experience in the banking industry and has been recognized as a top-performing mortgage specialist and top-performing sales associate with TD Canada Trust. In this series, we'll be covering monthly mortgage news and updates, as well as everything an investor or home buyer needs to know about the banking and mortgage industry. So please join us in welcoming Kim Nguyen. Hey, welcome everyone to the first episode of the Commonwealth Home Ownership Mortgage Education Series, I guess. My name is Phil Wong. Joining me as always is Brad Price, and we have our special guest, Kim Nguyen from Vine Group.
Hi, everyone.
Awesome. Thanks for joining us, Kim.
Thanks for having us, or thanks for being on our show. Sorry.
Cool. So in this episode, we're going to talk about a little bit of a market update, but we're going to dive into some of the details related to interest rates, what lenders are up to these days and how they're viewing buyers, investors, and some of the specifics that they're looking for from people before they'll loan them money. We're going to talk a little bit about the stress test and also some of the price ranges that we're seeing most of the demand.
Mm-hmm. So Kim, I know interest rates are all-time low right now, but where do you see them going at this point?
So just to kind of give you guys an idea right now, I feel like usually when we're looking at interest rates with lenders during this time, so December, January, February is usually slow season. So there's not a lot of promotions that come out. But again, in this kind of environment, we actually do have one lender that did come up with a promotion, and their interest rates right now are starting in the 1.44%. So usually rates like that.
Wow.
Yeah, usually rates like that are, it's unheard of. It's more common for those who are buying a home with less than 20%, like an insured mortgage, but we're seeing that available on the conventional side as well. So given that, and it's a big lender, usually what happens is when one big lender drops their rates, the other will follow suit. So I honestly think that rates should go around that amount, if not a little bit lower too, just depending on how the next month or so rolls out.
Okay, and has the news of, I don't know if you've heard it, but has the news of the vaccine rolling out has any effect on how lenders are structuring their interest rates at all at this point?
Not so much, to be honest with you. So I think the thing is that they're really banking on the actual demand, right?
Mm-hmm.
So vaccine or no vaccine, there's still a huge demand across Canada and including Alberta, shockingly enough. So that's why, be prepared. There's going to be a lot more offers coming up pretty soon here.
Okay. With the interest rates low, but it makes it easier to buy, but the lender requirements have also shifted a little bit as well. Is that correct?
Yes, it has. So I think there's two ways of looking at it. In terms of lender requirements, if you are a real estate investor, I find that they're really, really honing in on your actual T1 general. So as tax season is coming up, just be really mindful of what you actually, your numbers that you claim on there, simply because right now, if you had a rental property, most lenders would just want to see your lease agreement, and that's pretty much it, right? Your lease agreement, mortgage statement, just to kind of, roll that into the expenses. But now what we're seeing the trend is they also want to see your T1 generals just to see if you've had any major repairs or expenses, right? Because now that stuff factors into the whole equation as well too. It wasn't so heavily viewed before, but now it really, really is.
Just to back up a little bit, for those who are unfamiliar with a T1 General, can you explain quickly just what that is?
Yeah, the T1 General is that massive package that you actually send to CRA when you file your income taxes at the end of the year.
Okay. And then
Yeah,
that's
so
where you would, sorry, go ahead, Brad.
yeah, I just want to add to that. So when you're actually doing your taxes, each property you have, each residential property that you have, you would fill out a T776 form, and that would show your income, your rental income for the property, and a list of all the claimable expenses. So it's really important that you actually fill that out correctly. And then part of that, you would have your capital cost claim that you can also utilize to either depreciate or not depreciate a property. So if you're looking like you're going to have to pay taxes from, a higher amount of income, then you may look to offset that, paying that tax by utilizing a claim against a property. So once you've put together all your T776 forms, that'll essentially roll into your T1 general. So at the end of the day, throughout the year, any expenses that hit those properties will then show up in your T1 general. So it's just like when the bank says, well, I want to see your notice of assessment for the previous year. They'll also now ask for your T1 general so that they can look at all of those expenses for all of those properties that you own.
Exactly. So, because the big thing is that when you're buying an investment property, they want to see if you have existing rentals already, like what does the performance look like, right? So if there's one year that you did significant repairs, just be mindful of that, because even though it was just the 1 year, if you did claim it, and you're looking for future financing and the lenders want to see the history of the performance, even though it was a one-time occurrence, to them, they don't know that, right? They have to go off of the most current year, which then could affect your financing, right? Because you have that large expense.
Which then affects your DCR, your debt coverage ratio. So then it doesn't look like your cash flow is doing as well. So then lenders might not lend to you, correct?
Yes, exactly.
Okay. Kim, Phil, let's dive into that one a little bit more. So Kim, for people that don't know what DCR is, can you explain that and how that relates to whether it be one property, two properties, or 10 properties that you might own?
So the DCR is the debt service coverage ratio that banks take a look at, right? Just to see if your rentals are performing. And essentially, like the long and short of it is they're taking a look at all the income, and they're also taking a look at all the associated expenses. And they want to see at the end of the day, is the income enough to service all the expenses and then some, right? So the idea behind that is we want to see it at like a 1-to-1 DCR. Some lenders may want it a little bit higher, so they want you to pocket a little bit more extra cash flow. But essentially, if it is a 1-to-1, meaning all of your income is enough to offset all of your expenses, that's perfect, right? Then there's nothing, it's a complete wash when we're doing your application. Whereas if it's a little bit lower than that, then it gets treated as a debt, right? Like a monthly occurrence, like a monthly debt that you have to service, and your income has to be enough to obligate that.
So a quick question for you then, Kim. If the DCR, because the DCR the banks are looking for is around a 1.2, right? So the income has to exceed expenses by 20%.
20%, yeah.
So if it's 20%, do the banks consider your debt a wash? Do they consider that as like, looks like you have no debt at all?
Yeah, pretty much.
But what if it doesn't reach it? So what if it say like it's a 1-to-1? Do they consider all that debt, or do they consider just a portion of that debt?
Just the portion of that. But again, it depends on lender to lender too, right? So the majority of it though, they would consider, so let's say it's below 1. Let's say it's at a 0.90, right? And there's a little bit of a shortfall, like every month it's $200 or something like that. So essentially it is still washed, but again, like that $200 that has to come out of your pocket to service this rental, that gets added in the overall calculations, right? That I treat it, I kind of explain it as if, like, let's say you had a car loan or something that you have to pay $200 a month. It'd be the exact same way. They treat it as an ongoing loan payment that you need to service.
Okay. So they don't consider it as the entire liability, just the portion that you have to pay.
But again, it depends on the lender, right? But majority lenders, that is the case.
Okay, that's good to know.
And Kim, is there a point where the DCR gets to a certain level that the banks actually view it as income, not necessarily just a wash, but they actually will then count it towards your income, and it shows that you have increased income?
Usually I find like when we're at the 1.3 level, 1.3, 1.4 level, like that's strong cash flow, right? And again, like the story has to make sense as well too. Like if we can, if there's multiple properties performing at that and there's no property in the portfolio that is below, then we have a strong case study, right? We can tell the lenders like, listen, you know what, like overall this portfolio is doing really well. Like here's a nice surplus. Can we please add it? It is an exception though, right? Not all banks will take a look at that. So usually banks, they tend to go on the conservative side and they'll say, hey, if it's a wash, like if you're making money, it's just a complete, it's zeroed out, right? But again, to use that surplus though, it is an exception and it has to be a strong exception.
Okay.
Is just there's so many questions I have, but
Yeah.
is there when the banks are looking at a property? So for example, when I submit some paperwork, I have an account for each property, and each account has a reserve fund in it. There's a balance in every single account for each property in case something was to happen.
Yeah.
Do the banks look at that and add up all of that money, or do they look at each property and say, there's not enough money here, or there's
They don't even care about that.
They don't even care.
Yeah. It's the weirdest thing because, once upon a time, like I've been in the business now 13 years, right? And once upon a time, banks actually did care about your balances and your checkings account, savings account. And now it's just a mere, like a number to them, right? Even though you have a significant sum, like it helps to some degree, but not by much though.
Okay. So even if have like $1 million worth of like liquid assets, but you're technically at the financing wall,
Yep.
despite knowing that you could liquidate your assets and pay for all the debt, they still won't give you a mortgage because you're at that wall.
You're at that wall. Yeah. If you've
Wow.
reached the limit of the number of doors, I've had lenders come back and be like, you know what, it's just too much exposure for us, right? Like we get that you have $1 million in the bank account, but still like to add on more debts on your growing portfolio, like I usually find like that's the case when you've got, I say like the financing wall is usually between like 7 to 10 properties, right? That's when it gets a little tricky. And at that point, like even if you have the $1 million and stuff, most banks, you know what, they may just come back and do like maybe a one-off perhaps. The chances are though, especially if the property is in Alberta, unfortunately, location matters too, right? If your entire rental portfolio is in Alberta, you're planning to buy another one in Alberta is just known to be risky, right, to the lender. So it would be a tough win for that one.
Okay.
So before we jump into the Alberta discussion, is there anything else that lenders are requiring from investors or from first-time buyers that maybe they weren't pre-COVID?
Yeah, we'll touch base on the first-time buyers, right? One common thread that I've seen here is that they are heavily looking more into your bank statements, right? So they're seeing like, did you take advantage of any CERB payments or anything of that sort, right? Any benefits? Because as you know, like once upon a time, like CERB was as easy as pressing a button to apply and just get it, right? And the biggest thing is that if they see any type of those payments where it doesn't make sense that you would qualify, that is an automatic no from the lender. So just something to be mindful of, right? I know there's some clients out there that just applied for it for the sake of applying for it. That could be very detrimental down the road. And another thing too is that lenders are being a little bit more picky in terms of your income. So they are asking for your 2020 year-to-date pay stub just to see like, does it align with what you were supposed to make? Because as you know, in a lockdown, some people can't work, right? And if that is the situation, we have to offset it and we have to explain to the lender, why your year-to-date figure was lower. It's just a COVID thing now.
Okay. So is there a huge difference in requirements between an investor and a first-time home buyer?
I would say not too much, right? When it comes to an investor, I find the only extra piece of work now that wasn't required before is the statement of real estate rentals, right? That one form that's attached to your T1 General.
Mhm.
That wasn't mandatory before because there were a lot of lenders that were just okay with the lease agreement. They were completely okay, but now it's becoming more of a common thread that they do want to see it.
Okay.
Yeah, I think there'll be scenarios where they have to go by lease agreement because you may have just picked up the property within the last financial year. So,
Or if you
buy as many as you can.
yeah,
in that year.
yeah, like, or if you just recently converted, let's say, your primary residence to a rental, right? Then we have nothing. So
Yeah.
in that case, that's okay. But if
Okay.
you own it for a few years, it's kind of hard to get by.
Hmm. Well, hopefully you got to pick up a cash flowing property up front then.
Yeah.
Yeah. In terms of lenders, and how are they viewing Alberta different than the rest of the country?
Yeah, so I kind of alluded to that earlier on. Like, I feel like, Alberta with the whole COVID situation, double whammy, right? Number one, COVID hit us. Number two, oil and gas and energy sector. We've taken a beating there. And then also on the commercial realm as well, too. So there's a lot of negative news in the media, and that doesn't help things, right? They see Alberta and they see all these negative headlines. They, hear about our unemployment rates. And of course, it scares them, right? Because at the end of the day, you have to remember lenders are still a business, right? Even though they're a bank, people always forget that they're still a business at the end of the day. So if you've got money to lend, like, you probably want to lend it to someone less risky rather than more risky area, right? So I find, like, in Alberta, we are scrutinized a bit more. Like, there are certain policies where it just doesn't apply to Alberta. It applies to the rest of Canada, but it doesn't apply here. So, one of the lenders, I know we chatted about this before, where if you're buying a rental in Alberta, they would cap you at only 3 properties. They will only do 3 rental properties for you, right? Whereas before, that wasn't the situation. But that same particular lender, if, let's say, you're buying a rental in BC, Ontario, anywhere else, not an issue. But it might change. I'm hoping it'll change. I know, like, things will pick up. It will change. It's just a matter of when.
That's something that that did come up in a recent conversation with is that their claim is that the policy will change. It will change back eventually. They don't know when, but
It should, yeah.
Yeah, but we'll see if that comes to fruition. So with the claim of this economic bounce back for summer of 2021, Kim, do you see the banks starting to look at maybe increasing interest rates at that time? Like, what do you see for this year? What's your thoughts?
So I think, like, especially if we're looking at it in the variable aspect, like, I don't think Bank of Canada can even increase it by even a 1/4%. It's just with COVID still being, like, the big problem at hand, like, there's so much uncertainty to it, right? And the damages of it is still kind of unknown, in my opinion. I feel like we still haven't really felt the effects of it. And I think there's, as more time passes and as COVID still, isn't gone yet, that's when we're going to see a lot of problems within the economy. So there's just no way that we could even increase interest rates. I would say, like, what they're saying is, with interest rates being in the ones right now, expect this to stick around for a little while. Like, expect this to stay around. Like, this is the new reality. And even with the vaccine coming in, again, everything's still so new, so fresh. We've never been in this predicament before. So yeah, things don't move that fast either. So even if vaccine's great, the rollout, it still takes time, right? You can't fix an economy. We can't fix it within the matter of months. It takes time.
I mean, to get herd immunity, you need anywhere between, depends on the virus, but between 70 to 90% penetration.
Yeah,
Right.
that's
So
a lot.
so 70% is ideal. So, 70 to 80% is probably where you want to be before you can say, now everyone's safe to move around without risk of, large scale infections. So, and we're at what, not even 1% yet in Canada.
Yeah, and I just think that it's a long ways.
So I think it'll be a ways. Yeah.
Yeah.
So
good news for buyers, though.
Yeah.
Those who transfer the mortgage. Great news.
So with interest rates being low and this kind of funny situation where we're seeing house prices continue to increase, specifically for detached, but with that and the reduction in the stress test not too long ago, like, what are you seeing? Where are you seeing the demand, and how has that reduction in the stress test helped buyers?
I think, like, So it's almost like the perfect storm, because if you've got the reduction in the stress test along with low interest rates, there's a lot of clients that have always been on the fence of, oh, should I buy, should I not buy? And because of this perfect storm, it's the great opportunity, right? If you've got rates sitting right now in the mid ones and the stress test that has dropped, quite a bit since the inception of the whole stress test ordeal, I mean, it just makes sense, right? But if you need a place to live, you've got, solid employment right now, everything makes sense right there.
And the stress test, correct me if I'm wrong, but it's 4.79?
You've got it. Yeah.
Okay, percent right now? Okay.
So what is the optimal, optimal's the wrong word, the median price range you're seeing most of the purchase contracts come in at, Kim? And like we chatted about a little bit earlier, probably not seeing too many of the $8 to $1.2 million purchase contracts come in right now, even though cheaper money. I mean, it's
Yeah, it's just the demographic that would buy in that range anyways is kind of, they're hesitant, right? That, like, I'm seeing that demographic go down even lower, and where I'm seeing the hot spot anyways is between the 400 to 500, right? That is the hot spot, like right in between those two areas, because again, you're getting the best bang for your value at this point.
Mm-hmm.
Yeah, absolutely. And just on the back of that question, I guess, what are you seeing a good number of applications being approved?
I think it depends too. So for me, yes and no. Okay, so the ones that are getting approved, I find, are the ones that have been in, like, let's say, in jobs that haven't been affected by COVID, right? But again, like someone such as, I have a lot of clients that own their own business. And of course, a lot of them had to shut down, right? And because of that, like I'm seeing a lot of small business owners get a harder time for financing, right? Just given the effects of COVID. Anyone in like hard pressed industries such as the airline industry, hairstylists, any estheticians, like my nail salon client owners, like these industries have just been hit so hard that with them, even though like, they have the funds to buy, like previous year income has always been good. Just the fact that they've been shut down for so long in 2020 and even currently up to today's date too, that has really, it's really dampened their abilities to get an approval, right? It's just been very, very tough. But on the other end, I've got clients in IT or clients that have the ability of working from home. Like nothing has really changed in their day-to-day income. Those clients, no issues.
Okay.
Interesting. What about the demand shift for vacation properties?
That one, for some reason, so I'm finding that it's actually increased. So
Yeah.
I think it's the weirdest thing. It's so bizarre, but I'm getting a lot more inquiries where I have a lot of clients again who want to buy homes in Canmore, just out closer to the mountains. And again, it's just the second vacation property because I believe the logic, and this is what I feel, is that now that we're shifting into a year where you're able to work anywhere at all, why not pick a place with the scenery, right?
Mm-hmm.
Why not have that flexibility? Yes, we can't really travel on the planes right now, but again, if you can get yourself a nice cabin or something like that out in the mountains, why not? But the demand has definitely increased though, like a lot more questions surrounding vacation homes for sure.
Mm-hmm. I guess that makes sense too, with seeing the house price increase in single detached as well, right? And the decrease in the condo demand.
Yes,
I think
and then
people are,
also,
I think people are just moving away from that tight space so they can to a more roomy location where they can actually work from home.
acreages. Yeah, acreages. That's a big one too. A lot of acreages. A lot of people looking into that realm because again, like if you don't need to commute to downtown Calgary for your job anymore and you can do it anywhere, why not do it on an acreage?
That's true. That's true. So, I mean, this is great, Kim. What would you say is a tip based on everything we've talked about and the current state of the mortgage market? What would your number one tip be for anybody that's looking to obtain financing at the start of this year?
my biggest tip, and the tip that I've always recommended, is if you are looking to step into the mortgage world, like thinking about getting financing, whether it's for your first home or for a rental property, just get pre-positioned, right? Like you have to do that mortgage pre-approval, and get all your docs reviewed, because the lending environment has changed so drastically. And I feel like within the upcoming year, it's going to continue to keep changing, right? As new things come through, like, lockdowns get removed, things are constantly changing, right? And as things are constantly changing, lender appetites are also changing as well too. But the best thing that you could do, the best tip, is that if you are interested in looking, you have to get everything reviewed. So that means, you've got to get your income checked, you got to get your credit checked, because income is critical, right? If say you made 100K last year, but then due to COVID, it's been cut down, like those little small changes, you may not personally think that affects your application, but it does, right? Or even credit, right? If I pull your credit and I see that there was previous deferrals and stuff, of course, lenders will have every right to ask you about that too. So we need to have a good story. That's why now more than ever, don't go out and blindly shop. Like you have to get a full review, because we have to review every little detail, because your deal will get like ripped to shreds. It will be nitpicked.
Okay, perfect. That's good to know.
That's great. Awesome. Well, until the next episode, Kim, thank you very much. This has been just an absolute eye-opener. So much information, and look forward to doing it again.
Sounds good. Thanks, guys.
Yeah, thanks, Kim. Talk to you soon.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, remember to get out there, take action, and create a life of wealth by design.